Hello, my dear students. I hope you are all safe at home. Now, I start a chapter in financial management, that is, working capital management. Before I explain about working capital management, first I would like to say about the balance sheet of the company. You know, there are two sides in the balance sheet. One is liability side, another is asset side. Liability side is also called as sources of fund. Sources of fund means where we raise the fund, the source where we raise the fund. Another side is asset side. It's also called as application of fund, where we invested the amount or the fund which is raised. Okay, we come to the liability side. There are two sources of fund. One is long-term source, another is a short-term source. Long-term source is also called as non-current liabilities, and short-term source is also called as current liabilities. Okay, long-term source, that is non-current liabilities, whatever the money fund which is raised through long-term source, which is invested, which is applied in a long-term assets. Long-term assets is also called as non-current assets or fixed assets. So, in fixed assets, the money which is invested in fixed assets is from the fund or the money which is raised through long-term source. In the same way, the money which is raised through short-term source, that is current liabilities, which is invested in short-term assets. Short-term assets are also called as current assets. Now it is clear that short-term fund or current liabilities which are invested in the current assets, and if any excess amount which is invested in the current assets over and above the current liabilities, that is called as working capital. That is called as working capital. Now, the working capital means it is the difference between the current assets and current liabilities. Current assets and current liabilities. In other way, we can say that it is that portion of long-term fund. It is that portion of long-term fund which is invested in current assets. First I told you the long-term fund which is invested in long-term assets, and the portion of the long-term fund which is invested in the current assets, that is called as working capital. That is called as working capital. Now the formula of working capital is current assets minus current liabilities. Current assets minus current liabilities. Why we need working capital? We need working capital for the day-to-day operations of an enterprise or a company. Day-to-day operations. Say we need money for purchasing raw materials, we need money for paying the payment of wages and other expenses we incur during the operation of the business, that is called as working capital. See, I just told you working capital is the difference between current assets minus current liabilities. The formula of working capital that you know, current assets minus current liabilities. What do you mean by current assets? You know what are the current assets? Current assets are those assets which in the ordinary course of business can be converted into cash within a year. So I already told you that current, the amount which is raised through short term source and invested in the short term assets, that is called as current assets. And next we have to make the payment of short term source, that is current liabilities. How? It is out of the amount which is realized from current assets. Now the current assets are those assets in the ordinary course of business can be converted into cash within a year is called as current assets. For example, debtors, sundry debtors, bills receivable, outstanding incomes, prepaid expenses, stock, etc. They are coming under current assets. Now, current liabilities. What do you mean by current liabilities? Those liabilities which are to be paid in the ordinary course of business within a year out of current assets or earnings of the firm. See, we raise some money through short term source, and that money which is invested, and the current liability is the liability which is payable within a year out of current assets or earnings of the firm during the course of business operation, that is called as current liabilities. So for working capital we need two important items. One is current assets and it is current liabilities. Current assets, those assets in the ordinary course of business can be converted into cash within a year. Current liabilities, those liabilities which are to be paid within a year in the ordinary course of business, either out of current assets or out of earnings of the firm. So that is called as current liabilities. Okay, you know what is, you have understood what is working capital. Now we'll see the types of working capital. Types of working capital. There are 4 types of working capital. What are those 4 types? The first type is gross working capital. When we say what is gross? Gross means nothing but the total of all current assets is called as gross. we are not taking into account the current liabilities here. We take only the all current assets, and the sum total of all current assets is called as gross working capital. For example, sundry debtors, stock, bills receivable, outstanding incomes, prepaid expense. You take all the total of all these current assets, then the figure ultimate, the final figure will be what? Gross working capital. This is the first type. The second type is net working capital. What is net working capital? It refers to the difference between current assets and current liabilities. See, first you calculate the gross working capital. From gross working capital, you deduct current liabilities. You know what are the current liabilities? Current liabilities like sundry creditors, bills payable, bank overdraft, and short-term provisions. These are all coming under current liabilities. When we deduct all these, the total of the current liabilities from the total of current assets, then we get what? Net working capital. Net working capital is nothing but what? Current assets minus current liabilities. Current assets minus current liabilities. Next, third type of working capital is permanent working capital. Permanent working capital means this is the fixed amount which is required for the day-to-day operation of the firm or the smooth running of the business operation. It is a fixed amount we need regularly. We need regularly one amount for the smooth running of the business operation. This is called as permanent working capital. So here the amount of working capital which is needed in the ordinary course of business, normal course of business. The amount of working capital which is needed in the normal or ordinary course of business, that is called as permanent working capital. Permanent working capital. Then what is temporary working capital? The temporary working capital is that portion of working capital which is over and above the permanent working capital. Anyhow, we need certain amount, fixed amount for the day-to-day operation of the business. Sometimes due to certain reasons we need extra amount. That is, extra amount means the amount which is over and above of the fixed or the permanent capital, working capital. That is called as temporary working capital. What is temporary working capital? Temporary working capital means it is that portion of working capital, which is over and above the permanent working capital. When temporary working capital is needed, it is arised when sometimes the business gets unexpected orders. They do not know the number of orders they receive, but unexpectedly they receive the large order. then we need extra amount for buying the raw material, for making payment of wages, etc. Or sometimes there is a sudden increase in the price of raw material, sudden increase. So then we need to pay extra amount. That extra amount, that is working capital, that is temporary working capital. Temporary rise in the wage due to overtime. Sometimes overtime needs to be done. Then the laborers will be paid overtime. For that amount is required. That is working capital. We need extra working capital. We need. So that is temporary working capital. So that is unexpected orders, sudden rise in the price of the raw materials, and sudden rise in the wage, or temporary rise in the wage due to overtime. These are the 4 types of working capital. 1, gross working capital. Second one, net working capital. Third one, permanent working capital. Fourth one, temporary working capital. With this I finish this class, and in the next online class I will take the factors determining the size of working capital. Thank you very much.